This is USDA Module 2. In this module, we're going to review a little more about household income limits, employment, credit, and rates and terms. So let's get started. So understand that the USDA, this program is there to help lenders work with low and moderate income households. They need to be living in rural areas, and the purpose is to help them make home ownership a reality. So by providing affordable home ownership opportunities, this is also going to promote prosperity, which in turn will create thriving communities and improve the quality of life in rural areas. Now, one of the things that USDA is very strict about are household income limits. They are one of the few mortgage programs that is going to enforce income limits for the borrower. And to qualify your total household earnings, they cannot exceed 115% of that area median income. Now, I want you to keep in mind that household income actually refers to the earnings of any person living in the home over the age of 18 that has a job and is earning income. It's not just based on the mortgage borrower. So they kind of follow those down payment assistance program household income limits that we sometimes walk into. So why don't we, let's go back. Why don't we visit the USDA income limit site? Now, as I had stated in Module 1, USDA has a great site. It's pretty much all in one. We're uploading it right now so you can kind of see it. We did this in Module 1. We're going to do this again because what I want you to know is where you need to go. So first and foremost, we're going to go to Single Family Housing Direct right here. All right, and we're going to select an assessment. We can look right here. You can do your self-assessment, all right, or you can go over here to income limits, and you can see what the median income limits are going to be. So let's open that page up so that we can take a look at the different income limits. All righty, so here we have a map of the rural area, and remember, it's single family. So if we scroll down, and the income limits will be upgraded every year as they raise. So if you have one person, you'll see it tells you what the very low income, the low income, the moderate income, and it gives you that for one person. Then you see as you have more people, it goes here, okay? So, and it gives you all the different areas. So if we were going to go up to the map and click on Colorado, now it's going to give us the median income for Colorado. All right. And here you go. And it has it done by different counties. And so it helps you to determine if their income is going to qualify for that area. Okay. So let's go back to our PowerPoint. Here we go. Okay, so we're back. Anyway, so that's where you're going to go onto the USDA website, and it's in the Resource Center to start checking. And it is, I'm going to really stress this right now to my loan originators, all right? It is not the responsibility of your processor to check income limits or property eligibility. Before you do a pre-approval on a loan, you need to be checking the property eligibility and the income limits for your borrowers. And as I had stated in Module 1, every 5 years they reassess areas. So what may have been considered rural and USDA eligible 5 years ago may not be considered eligible now. So it is really your responsibility to make those checks before you do the pre-approval letter and submit the file into processing. So let's talk about those employment guidelines. You know, most mortgage lenders want to know that your borrowers have stable, reliable jobs and income to support the home loan payments going forward. And the USDA loan, just like most other home loans, is generally going to require a 2-year work history. Now, there is no set minimum period that an applicant must have worked for a particular employer. However, the lender is responsible to confirm that the applicant's job for the previous 2 full years, as well as the fact that their income has been steady. So we want a 2-year work history. We want full-time employment. And we do, at the USDA, consider self-employed individuals, okay? But again, they're going to be looking at 2 years tax returns, 2 years business returns. They may ask for a P&L. They may ask for a balance sheet because, again, they have to look at those income limits that are set by USDA. Now let's talk a little bit about those minimum FICO scores. The USDA does not necessarily set a minimum credit score. However, you are going to find that most lenders are setting their own credit score and requiring a 640 FICO. They will accept alternative credit such as rent history, insurance payments, and utility payments if they do not have traditional credit. You need to absolutely be discussing any credit overlays with the lender that you are working with on the USDA loan. And make sure that if need be, they do a manual underwrite for alternative credit. So, as you know, evaluating an applicant's creditworthiness requires a determination of the applicant's ability and willingness to meet their debt obligations. If they are living at home with mom and dad and they don't have a rent history and they don't have any proof of making payments on anything, chances are they're going to have to wait, establish credit, and get a rent history established with their family that they can document and cancel checks. All right. So if they don't have a rental history and they don't have alternative credit, it's not a no. Absolutely not. It's a no for now until we can help you establish some credit and put you in a position where we can, at the least, do a manual underwrite, okay? They're not, they need to make sure that somebody's going to pay them their money back. Now, understand there are 2 types of credit reports. There's a tri-merge credit report. There's an in-file credit report. There's free credit reports, and you can get their credit reports from any one of these areas, okay? In the program's handbook, which is the handbook 1-3550, when a complete application is received, the agency will order a tri-merge credit report, or they may use the acronym TMCR. And for each applicant, the loan origination system is going to run that credit on each individual credit or applicant. Now, the TMCR is going to contain information from the 3 major repositories, Experian, Equifax, and TransUnion, okay? And they're going to be looking at that to determine their credit score. Now, an in-file credit report is generally a single repository report ordered by the agency at no additional cost, okay? And the in-file credit reports are primarily used for the unsecured section of the 504 repair loans. So if they're buying a property and it needs repairs, the USDA offers a repair loan, but it can't be less than $7,500. So they are there to help with those type of repairs. And if your borrower doesn't want you to run the credit, then they can go to www.annualcreditreport.com and they can obtain their own credit report. Now, you can only use that for the purposes of pre-qualifying them, but at least it gives you the ability to see what you are working with on their credit. And always remember that a soft pull credit score may not be the same as a hard pull credit score. So you need to keep that in mind as well when you're starting the pre-qualification process for a potential USDA borrower. Now, whose credit is reviewed? Well, for all states, any note signer, applicant, co-applicant, and co-signer is going to have their credit reviewed. Now, for community property states, non-purchasing spouses do have to have their credit run, but if they're not on the loan, and we're talking like specifically Texas is one, they just are going to be including the debt of that spouse, but they're not going to be looking at the credit scores as a reason to loan or not loan, okay? But in a community property state, traditionally, this is what happens. And as I said, their obligations have to be considered in the applicant's total debt. The applicant's non-purchasing spouse also must provide a copy of their credit report. And the credit history is never considered a reason to deny a loan, okay? Any judgments, though, must be paid in full unless an exception is granted by the loan approval official, okay? So whereas we can get away with judgments not being paid either due to statute of limitations or the fact that they're small judgments, you cannot assume that with the USDA. Now, let's talk about reviewing the credit report. It's important to compare the information on the credit report with the form RD 410. Okay, the Uniform Residential Loan Application will verify the applicant's name, address, and social security number. You want to compare the employment information, rental data if available. You want to compare all of that to the report. You need to ask the applicant to clarify any discrepancies, and generally we would want that to be done on a letter of explanation, all right? You need to ask them about any recent inquiries. People are shopping for mortgages. There's nothing wrong with that, but you need to confirm if they've opened any new accounts. So when you're reviewing the credit report, make sure you have that checklist. Make sure their name, address matches the 1003. Make sure you ask about any kind of inquiries, any addresses that you see on that credit report that don't match what's in the 1003. You need to get a letter of explanation. Is an applicant responsible or only an authorized user? Generally speaking, if they're an authorized user, we don't need to hit them with the payment because they're not obligated to that debt. But every lender has an overlay, and so you always want to check with your lender underwriters to make sure that they'll allow the judgments to stay, or to make sure that they will not hit them with the authorized user debt. Okay, if they do, then they need to come off as an authorized user so that they are no longer construed as being responsible for that debt. Now, if the score is under 640 for any 502 loans or USDA loans, you're going to need to have a verification of rent, okay? If they don't have traditional credit and they need to use alternative credit, or there are only 2 scores, you need to, again, consider that non-traditional alternative credit. You have to review for indicators of any unacceptable credit. So look at the credit report. If there's late payments, judgments, foreclosures, anything like that, we need to know what that is all about, okay? Now, again, that's if the score is below 640 or below 620, you're going to need to really document and really support having the lender loan the money from the USDA. So credit disputes and non-derogatory disputed accounts. Let's kind of look at that a little bit. So if the loan originator is able to determine non-derogatory disputed accounts are acceptable, then they can proceed with underwriting. The disputed account is going to be considered non-derogatory if one of the following items applies. The disputed account has a zero balance. The disputed account states paid in full or resolved on the credit report. If the disputed account with the late payments are aged more than 24 months, and if the disputed account is current and paid as agreed. So what would you need? You need documentation to support the reason and the basis of the dispute with the creditor. You need to determine what the impact would be on their credit scores. You need to include the minimum monthly payment stated on the credit report. And if there's no minimum monthly payment stated on the credit report, then you have to take 5% of the balance of the account or the amount documented from the creditor. So get a letter from the creditor, because taking 5% could be an excessive payment. Now, what are we looking for on a full credit review? Again, if the credit score is below 640, or if they have less than 2 scores or no score, or if they have significant delinquency, you're looking at the verbiage, okay? You're looking at obtaining additional documentation to support credit, the rental, the mortgage, any alternative credit, utility bills, electric, cable, cell phone, and you need to review for indicators of any unacceptable credit handling. And again, you're going to look at the credit report, at the credit history worksheet, and that you would find on the credit report. So again, USDA has no credit score requirement, and the applicants are expected to demonstrate a willingness and ability to manage their debt. If they have no credit history, non-traditional trade lines are acceptable: rent payments, utilities, auto, monthly child care, school tuition, phone bills, gym memberships. If you can think of anything else, add it to your list. They're very flexible. Now let's talk about those rate end terms. The interest rates vary and are determined by your individual lender. So if they put money down, you may get a lower interest rate. If they have a high credit score, you may get a better improved interest rate, okay? You always want to comparison shop between your lenders. As a mortgage broker, you have the ability to do that. And it is required of you to do your due diligence to ensure that your borrowers are getting the best USDA available. So again, lenders have their overlays. Lenders can have different interest rates. The USDA loan is only guaranteed at a 30-year term and at a fixed rate. There is no other options for terms. So 30 years fixed. That's it. So this concludes the end of Module 3. I'm sorry, Module 2, my bad. And we're going to move on to Module 3. And we're going to go over a few other things in Module 3 to include guaranteed underwriting system, or what we fondly call GUS, the features and benefits, the loan to value, and the mortgage insurance. Okay, so we will get started with that module soon.